In this lesson, we're going to look at the different participants in the market. It's important to understand who is actually trading so we can recognize their behavior and shape our own trading style accordingly. We break them down into two main categories: retail traders and institutional traders. The first group is retail traders. That's regular people like you and me. We don't have massive capital. We're usually self taught and we don't work for a fund or a bank. This comes with a few advantages. We can choose when to trade and if a setup is worth it. We're not forced to place trades every single day, giving us a lot of freedom in the market. Most importantly, we're small. Our trades don't move the markets, which makes our positions virtually invisible. That means we can enter and exit trades without affecting the price. But it also comes with a disadvantage. Most retail traders act in predictable ways, because we all learn from the similar sources like brokers or free tutorials. This makes our behavior easy to anticipate and institutions exploit that. Let's take a look at the second group. The second group is the institutions: hedge funds, banks, and prop firms. These guys are professionally trained and they manage massive amounts of money, often hundreds of millions or even billions. Their advantage: they can move and influence the market. They often create the conditions that cause prices to go up or down, and they profit from those movements. But here's the weakness and where we come in. Institutions can't place all of their orders at once. If they did, the price would spike or drop instantly. So instead, they need to break their positions up into smaller chunks and strategically enter them over time. That means they need liquidity. They need people on the other side of their trades. And guess who provides that liquidity? Retail traders. I'll show you an example now. In this example, we're in the German 40 chart on the daily. We're in a bullish market here, and the institution likely want to continue this trend. I've marked 6 points here on the chart. Each point is where institutions put in large amount of positions to influence the market. For example, in the first circle, institution puts in 1,000 positions. In the next 2,000, in the next 1,000 again. And then on the last 3 circles, they put their major positions in. They first grab all the liquidity from the market beneath all the previous lows, so all the retail traders go into their stop loss. If the retail traders go into the stop loss, the institutions can buy up their positions, and here in this example they did it. They bought all the retailers' positions up and then influenced the market to go out of this range. That's a common example of how the institutions influence the market with their positions and how they make multiple positions across a range to influence the trend. If we want to succeed, we need to think like the institutions. We want to be aligned with the smart money, moving in the same direction, following the same logic, and avoiding the traps they set for the uninformed. Retail and institutional players both need each other, but the ones who understand how the game is played, they're the ones who win. And in this series, I'm going to teach you how to spot institutional moves like these in the chart and trade with them, not against them. I see you in the next video. Bye.